At this time, more students are choosing to pursue higher education from undergraduate to graduate degrees. For most students, choosing college is also choosing a debt sentence. There are two types of student loans that people consider when paying for college: federal loans and private loans. Federal loans are disbursed by the United States government, and almost all students are eligible to receive them. There are three main types of federal loans. They are direct loans, PLUS loans, and Perkins loans. These loans may be categorized as subsidized or unsubsidized. When a loan is subsidized, the government pays the interest while the student is still in school. Unsubsidized loans still accrue interest while the student is in school. Private loans are offered by private banks and financial institutions. Eligibility for these loans are based upon the applicant's credit score. Private loans are known for less forgiving repayment options and higher interest rates. Students are always urged to apply for financial aid and scholarships that could provide grants to minimize the burden of debt they need to take on. Most students do not have the option to go through school without accruing some sort of debt. The current average student debt has increased 58% over the past 7 years. The average student debt is $37,000. If student debt had stayed constant with inflation, graduates would not be burdened with as many student loans. Wages have only increased 1.6% over the past 25 years, while debt has increased by 164%. Students currently have approximately $1.48 trillion of student debt spread across 44.2 million people. 11.2% of these loans are more than 90 days delinquent. Student debt affects both the borrower and the economy. While students are spending a good portion of their pay on loans, they are not spending the money elsewhere. Our economy is consumer-driven, so with less spending, we can observe less revenue and profits for businesses. Student debt is also hindering the housing market. More graduates are electing to live at home after college to assist with paying down the debt. According to the Federal Reserve Bank of Philadelphia, student debt is also preventing new businesses from starting. Graduates are unable to obtain business loans as easily as they would if they were not already in a ton of debt upon graduating. Those from lower income families are subjected to severe disadvantages when it comes to student debt. While these students are eligible for more aid, they tend to fall further behind in repayment as they have less access to wealth. One might assume those with more student debt would fall behind easier, but those graduates tend to take higher paying jobs, allowing them to pay off their debts sooner. According to TalkPoverty.com, only 7% of graduate students fall behind on loan payments, while 22% of undergraduates fall behind. Solutions for getting out of student debt are available. Federal loans provided by the government sometimes offer income-driven repayment plans, which allow borrowers to pay back their loans at a rate that is proportional to their income. In rare circumstances, some low-income graduates may qualify for loan forgiveness. Income-driven repayment is also helpful for people who may have small balances of debt, as they still allow for disposable income for housing, food, and other activities. While student debt is not enjoyable, it is part of the higher education system and is sometimes necessary to get a degree. It is important to take advantage of lower interest rates, repayment plans, financial aid, and outside resources to help minimize your debt. Financial planning is crucial to avoid bankruptcy. Always be sure to consider your starting salary and expected loan payments, and the most financial savvy school that fits you.